And Meryl, you just muted yourself.
All right.
There we go.
Your inside track to fundability and the opportunity to take a look at every single thing that's going on in this. Well, okay, I take it back. Not every single thing that's going on, just the really important things that are going on in the lender space, in what's happening to our economy, and where banking and lending is shifting. The first thing that I want to address, first things first, lawmakers, I always say once is a mistake, twice a habit, three times is like a way of life, a character trait. Well, lawmakers are finally taking this seriously because of the U.S. bank shams, those fake accounts that are about how people build their how banks get bonused by the number of accounts that they have, etc. And a U.S. bank, we talked about this on last Thursday. U.S. bank what got fined tens of tens of millions of dollars for creating false accounts. Well, now lawmakers are going, oh, well, Wells Fargo did it. Oh, now US Bank did it. Two of the top five have all been doing this, using this practice. So they're going to be weighing in, and we're going to see where this goes. But I think there is a will to at least regulate banks in some fashion, right? Some way to create of the most amount of clarity um, with regards to protecting consumers. These remember U.S. Bank; these guys were opening accounts, credit accounts like credit lines and credit cards at U.S. Bank with people who had good credit scores and had business checking accounts there, right, without their permission. So we'll be on call to watch that because that's going to be a thing that is going to continue to grow, and we'll keep you posted on that. Next, the next thing that is super potent is that a Florida community bank, Bay First Financial. Now, as you know, I'm down in Florida right now with the board of advisors meetings that I do every quarter, and I'm telling you, I'm taking a break from what I'm doing out here in order to keep us posted, right? Keep us on point to everything that we're doing. So, Bay First Financial has started offering small business administration loans, taking a page out of the PPP playbook and evaluating gross sales. Did I call it? Did I call it? We call it top line here at Get Fundable. They are looking at the top line, and these guys are using that as the only criteria for these loans. So, and they lent out, driving origination of 6.5 million loans for a total of 2.77 billion between February and May 4th of last year. Straight out, a page straight out of the playbook for PPP. So watch more of that. This is making waves, you guys. This is making waves. So we want to make sure that you know that automatic underwriting, because financial profitability is a page out of the P&Ls of yesteryear when they were evaluating profitability. But profitability is such a poor profitability, since you can write off, depreciate. I mean, tons and tons of real estate companies are not fundable because they write and depreciate all this property off when they have gobs and gobs of cash flow. So thank you, Bay First Financial. It's a tier 3 institution. But hey, the small guys, the small institutions are leading out. So mad props to Bay First Financial. I'm really excited to see where this goes, and they're proving up. And so far, there are the default rate on these are no different. It doesn't say that there's a better default rate. There's no difference in default rates compared to the ones that used all of the profit as the guide for fundability. All right. And finally, the last thing that we have today are subprime consumer lenders heading for a reckoning. Now, we knew this was coming. Because what's happening is that remember I told you at FICO World, we're meeting with the score development teams there, and they're saying that traditional banks, depository banks, are looking to try and compete with fintechs. They're trying to compete with neobanks, right? All this online capital available from investor pools rather than from lender profits. Well, what's happening here is because they've been fast and loose on their underwriting, since they've been fast and loose, there is not a lot of, they're finding that funding is becoming, I'm quoting now, funding is becoming constrained because lenders were focusing on borrowers with below prime credit score and offering products like auto loans, personal loans, credit cards, and short-term buy now, pay later loans. Every one of these in the lower registries of credit scores, right? Where do we know where this happened? We know how this happened from 2008 in the mortgage crisis. Remember, they took AAA tranches and put a bunch of junk in there. Not good, not good, not good. So we want to make sure that we will continue to monitor and continue to watch this, but these lower credit scores, these loan portfolios, they're selling on the secondary markets, just like 2008 sold mortgages on the secondary market. They are not there. There's a little bit of risk here, and it's higher risk than traditional lending for the same demographic. And we're not, and so far they're calling it, they're seeing cracks. They're seeing cracks. So that's our update today. Be sure, for those of you who are part of the tribe, be sure to go to the Q&A in just a moment on Zoom or on Facebook, and let's break it down. Let's talk about what's happening and how all of this applies towards your fundability. This is Merrill Chandler, your host of the Get Fundable Universe, and your guide to profitability as we go into these difficult times. You can count on it. We'll see you same fundable time, same fundable channel next week.